I want to thank our witnesses for testifying today. You're here at a pivotal moment for our economy. The recent turmoil in the banking sector could not come at a worse time. The Biden administration and many of my colleagues on the other side of the aisle and Capitol want to treat the symptoms rather than the disease. Our country is suffering from an inflation problem, plain and simple. Driven by the economic mismanagement of this administration, inflation is the underlying cause of the volatility we're experiencing now. My Democratic colleagues will roll their eyes just like they did every time Republicans sound the alarm on skyrocketing prices over the past 2 years. But let me walk you through it. When Democrats forced through their partisan $2 trillion so-called American Rescue Plan, they lit the fuse on runaway inflation. Instead of addressing this problem, the Biden administration went on a roadshow trying to explain away higher prices. They used the words like transitory, which, to be frank, didn't age well. The Fed was late to the game in responding to inflation, and they admit it. They had to play catch-up and raise interest rates 500 basis points at the fastest pace in modern history. This injection heightened interest rate risks into the financial system. Regulators and supervisors at the Fed were, again, late to react. Now, 3 of the 30 largest banks have been shuttered. There is still market volatility within regional banking, and we are now staring down a credit crunch as banks of all sizes anticipate more onerous regulations and market scrutiny. So let me be clear. If Congress and this administration do not respond correctly, we are just at base camp for the economic woes our country could face. A one-size-fits-all regulatory response to this crisis, which has been signaled by this administration, will work against promoting a vibrant banking system with institutions of all sizes providing a variety of services. Instead of a balanced system with small, medium, and large institutions, it will look more like a barbell banking system, with dominant too-big-to-fail banks on one end, as anointed by the government, and banks at the other end, too-big-to-fail banks anointed by Dodd-Frank and government backstops on one end, and a scattering of very small banks relying on government subsidies to survive on the other end. Such a barbell banking system with a missing middle of healthy regional banks is not good for communities across America. Vice Chair Barr, you've signaled your desire to go beyond reviewing supervisory failures that contribute to the recent bank failures. You have used this crisis to justify progressives' long-held priority to increase capital requirements and impose new regulations on banks. That predates this crisis, but you're using this crisis to justify your pre-baked ideas. The Fed's internal review, along with FDIC's report and recommendations on deposit insurance, lay bare the playbook for this administration's response to this crisis. More regulation, more government control, and more spending. I know my colleagues across the aisle will use today's hearing to discuss the debt ceiling, and I welcome that debate. We serve in the only institution that has actually addressed the debt ceiling, because I think frankly, I think what we have now is a larger debate about the economy, not just about the debt ceiling. And inflation and the spending is the reason why we're dealing with the debt ceiling at this time. So I'm glad that we acted and the House of Representatives acted and the President's now finally coming to the table to negotiate with the Speaker. But out-of-control Washington spending that led to this uncertainty that we're feeling in banking, that the American families are experiencing, it's the result of spending out of Washington. And Republicans are working to address that spending issue.